Hey everyone, hope all is well. Today I have Mehdi. He's a partner agent here with us at Real Estate 38. And the reason I have him here is because he has an extensive knowledge. In the past 10 years, he's been in the lending industry. You've led a team. You know all the ins and outs of the loan industry, and he's decided to come and join our team. It is an amazing resource. Thank you for coming in to speak to us here today.
Happy to be here.
Of course, yes. So today's topic is we're going to cover the CALHFA, California Housing Finance Agency, and the program they have put together, and you've probably seen it everywhere. So today we're going to clarify what Dream for All Shared Appreciation Loan Program. So what does that mean? They're pretty much down payment assistant. And we're going to go through all the questions that we have here to make sure by the end of this video, you have great knowledge of exactly how to approach this. Do you qualify? Do you not qualify? So let's go ahead and start.
Yes, sir.
All right, very good. So what is the Dream for All Shared Appreciation Loan?
It's a program by state of California where you can borrow up to 20% of your appraised value from the state of California. And guess what? You don't have to make a payment on it for 30 years when the loan matures or when you sell the property and move away.
Very nice. So if I would use this example, if I'm buying $1 million property and I don't have the down payment, so 20% of that million, so $200,000 can actually come from CalHFA.
Yes, sir.
Ah, very nice. So what is the maximum loan amount, that down payment assistant, how much can I borrow?
So it could be up to 20% of your purchase value. Now, got to keep in mind, the first loan should not exceed the conforming limit. And the conforming limit varies based on your county. It could be as high as $1,089,000 in Santa Clara, Alameda, but you should consult with your loan officer of what is that loan amount in your specific county.
That's right. So I verified this morning, Santa Clara County, Alameda County, San Mateo County, they are all at $1,089,000.
Yes, sir.
So the loan amount needs to be at 1089 or lower. And then the property needs to appraise at the purchase price. Let's just say you're buying a home for about 1.2 million. Okay, and the appraisal comes at 1.2 million. So then I can borrow 20% of that 1.2 million. That brings it down less than $1 million. So in this case, I definitely qualify.
Yes, sir. That is correct.
And I could borrow up to 20%. Okay. Are borrowers required to make monthly payments? Let's say we close escrow today. Am I making a payment in 30 days like I do to my normal mortgage?
You do not need to make any payments into state for that portion. So you still have to make the regular payments. On the first one that you borrow, the amount that you're getting from the state is payment free.
So if I'm hearing you correctly, this gives a buyer an opportunity to save about $1,100 a month off their mortgage on a regular basis because of this program.
Absolutely.
That is nice. And now, who qualifies?
So one of the beauties of this new program, state has finally adjusted the income for the inflation. Well, the problem we had with these programs in the past is the income level was so low, many of our first-time home buyers in the Bay Area wouldn't qualify. They have raised this limit to $300,000, which is much bigger than it was before, and now we have a bigger pool of our clients that can qualify.
So if I can earn, say, $100,000, I don't think I can qualify for $1.2 million home, but I can possibly qualify for maybe $650,000. I can still borrow up to 20% from that.
That is correct.
Okay.
Yes.
But if I earn $350,000, I may be disqualified because I earn too much.
Yes.
Okay. So there's definitely an income limit. Is there a limit to, say, I'm a first-time home buyer? Can I qualify?
Yes.
What if I owned a home 3 years ago?
So that is a great question, Zaid. State of California defines first-time home buyer as somebody that hasn't owned the home for the past 3 years. So if you owned the home 10 years ago, you sold it, and you haven't owned, you will still qualify and be considered a first-time home buyer.
But if I bought it 10 years ago and I still own it,
No, you could
does not work.
Yes,
Okay,
so your
it does not
ownership
work.
must have ended 3 years prior to
okay.
making
Thank you for clarifying that. So now, who can originate these loans? Is it like, because you have the bigger banks here like Bank of America, Wells Fargo, Citi, or is it a broker? Can anybody originate this loan?
Many of the companies you mentioned do qualify. However, you wouldn't want to go to your dentist for a nose job. It takes a specialist. It takes somebody that has done these programs before, knows the ins and outs, because our close of escrow is 30 days, 25 days. You want to be competitive. And if you go to a loan officer that has done this before, and you say something great all the time, you say you don't want somebody to learn and be trained on your file, right?
That's right.
Right? So you got to make sure you go to the right loan officer that knows this program.
So one of the number one complaints we always get is the process was great, but the loan process was a bit painful. It's like pulling teeth sometimes, asking for documentations over and over. So certainly adding another loan program to the process may bring a little bit of more, I need this, I need that. There's a little bit of delay. So be prepared for you to actually see a bit longer escrow unless you use the right loan officer that actually has done this before in the past.
Absolutely. And we got some really, really great guys that we worked with in the past, and we can refer them.
Yes, we do. Okay, so in regards to this down payment assistant, can I use it for closing costs? Can I use it for existing debt? Or can it be only for down payment?
So 100% of the program needs to go into purchase of this new property.
Okay.
It can be closing costs, down payment, or combination of both. You cannot use it for anything outside, so you cannot use it. But you mentioned when we were talking before, you had a great idea.
Okay, so the idea was, what if I have credit card loans or student loans that have high interest rates, but I've, say, saved up $100,000, and I want to buy $1 million home, and I have this 10% to use as a down payment. Now, on the flip side, if I can take this $200,000 down payment assistant and I have an excess of another $100,000, can I use my cash to pay down this loan? And the answer is
yes.
Okay, very good. So you could use your own cash to pay your debt. This down payment assistant has to solely go to the property and the property's closing costs. Now, on average, for $1 million purchase or $1.2 million, you're looking between $8,000 to $10,000, depending on the county, guys. So Alameda County, Santa Clara County, it differs a little bit of who covers up the closing costs. So with that being said, I can use it for the down payment, and I could also use it for the closing cost that is about $10,000.
Yes.
Okay. Thank you for sharing that. Do I have to take a class?
Yes. So there is a class. Luckily, you can take these classes online. It's usually about 7 to 8 hours. Make sure you check with your loan officer about approved courses. You don't want to spend the money, spend the time, and go somewhere that you have to redo it because they're not qualified.
Okay. When is this due? When is the loan due? Let's say I buy it today, and I've owned it for 3 years, and I have no plans of moving. Is it due?
No. So usually loans mature in 30 years.
Okay.
But you also have the option of selling it earlier if you want, which in that time it'll make it.
If anybody is like me, I move every 3 years. So yes.
If
If you're like me, it's probably due when I sell.
When you sell, Q&A in the program says whenever you pay that first loan, it will make it due. There might be some additional caveats, and we'd be happy to share one.
So what you're saying is, if I win the lottery and I want to pay off the $800,000 loan that I've acquired with the banks that we talked about, then that CALHFA loan is due too.
Yeah, state wants some of that lottery money.
That's right. Okay, so be careful, guys. So do not refinance. Do not pay down that first loan, because that $200,000 is going to come due. It's going to come due with profits. So if I have $1 million purchase, I have $200,000 from CALHFA, I have $800,000 from a banking institution. Now I turn around and sell this property 5 years from now for about $1.3 million. After my closing costs are all paid, I have gains of about $200,000, say. I'm rounding off the number, so please go with me here. So I have gains of $200,000. So I borrowed 20%. Do I have to give CALHFA 20% of the gains, which is 20% of that $200,000 that I've gained? That equals to $40,000. Is that true?
That is correct. Now we're oversimplifying it a little bit. There are some additional caveats that we'd be happy to disclose, but that is the gist of it.
Okay, very good. So guys, this is profit sharing program, meaning they will give you this $200,000. They will not charge you anything on a monthly basis, but you will pay that 20% of the gains. So if you've gained $50,000, if you gained $100,000, or if you gained $200,000, it'll be 20% of that gain. Now, what if there's no gain?
That is the good news. If no gains, nothing due. They're truly becoming your partner. If you haven't increased your value and you're selling it at a loss or at what you bought it for, you don't pay state anything. You just have to pay them the original principal you borrowed.
So when you say I don't pay anything, I don't pay them any gains. I just have to pay them the principal I borrowed from them.
That is correct.
Now, I read somewhere where this is kind of gray area. We don't know yet. Let's say I bought the property for $1 million and I borrowed $200,000. And a year from now, I got an amazing job relocation offer, and I'm going across country and I need to sell this property. Now I'm selling the property still maybe for $1,020,000. and my closing cost on average is about $60,000 to sell. Now I'm in the hole maybe $40,000. Who's responsible for that?
The state's verbiage says you still are responsible to pay the original amount, but these loss mitigations, as you mentioned, they're kind of gray area.
Like a short sale, like back in 2008.
Exactly.
Okay.
So state said you still owe them the original principal.
Okay, so be careful there. There's definitely some education that needs to be had, that if you do borrow 100%, meaning 20% from CALHFA and 80% from the bank, you have nothing out of pocket. If there is a sale that happens right away, there may be some loss, so you may come up out of pocket there a little bit. So thank you for sharing all of that. So we went through how, where. Now let's talk about should you use this program. So I have some examples here. And the interesting part is this is obviously great when you don't have a great down payment. And when I say great, 20% is great, meaning you're not going to have any mortgage insurance, right? You're just going to have the best rate possible in the market. Of course, you need great FICO score, income, and all of that. So let's just keep that aside and talk about the 20% down payment. So if we have buyers that have 3%, we have buyers that have 5% and 10% down. Is this program great for you? Absolutely. Of course, we got to run the numbers to make sure that it does make sense. But I would say, generally speaking, that is great for those kind of buyers that have saved up a little bit of money. They have great income. They want to buy early. This kind of gets you in the door. Now, again, you could use your money alongside the down payment assistance. So you could still, on $1 million purchase, you could do 80% first loan, 20% down payment assistant, and you could add another $100,000 to go to $1.1 million purchase with the 10% down, or you can keep that down, that 10%, that $100,000 in your account as safety net and all of the above. So I want to talk about the 20% down that already have it. So I have $200,000 down. I was planning to buy this $1 million home. This is all I could afford. I don't want to go any higher than that in terms of the monthly payments. But really my budget is not aligning with what I'm looking for. I really want to be near a specific town. So I should really go to $1.2 million. Now, this is a great way to get you into that neighborhood where that 20%, the good news, the 20%, you don't have to make any payments on it. So it's a silent 20% down. So now you're paying on your mortgage of $800,000. You are not making any money on the 20%, and you put that 20% down too. So you're technically doing about 40% down, almost, right, if you do the math. So that's a great way to get you into that neighborhood. But do I recommend it for folks that can afford, in a specific neighborhood, a perfect home that have 20% down, that could easily get an 80% loan? No. Here's why. Because I like to keep my profits. Meaning, this is a profit sharing program. Meaning, if you're going to get that 20%, and let's just say San Jose, by the way, in Santa Clara County, we pretty much double every 10 years on pricing. So if you're going to hold on to this property for the next 10 years and it goes up, say $500,000, you may give that 20% of the growth to CALHFA. That's $100,000. I'd rather keep that. So if you're looking to get further information, do please reach out. We do have the resources. We can play your scenario out to see if it does make sense, because we consult like that, and we'll definitely guide you through that process. So is there anything else you want to add, Maddie, to this that we did not cover today?
No, I think you covered pretty much everything.
Okay, very nice. Well, thank you again for your time. Thank you again for your expertise and your knowledge. And guys, as you can see, we are well equipped with information and data to guide you through this process. So definitely reach out if you have any questions about this program or any other program that exists out there. And my telephone number is 408-515-1613. Look forward to connecting with you. Bye-bye for now.